Your dad says buy gold. Your uncle insists property is the only safe bet. Your friend from university says you need to put every spare dollar into an index fund. We have all had this argument at the family dinner table. This debate never ends because most people are arguing from personal anecdote, survivorship bias tied to whatever happened to work for them in their particular decade. Selecting an asset that clashes with your specific timeline can lead to the active destruction of your savings purchasing power. To find an answer, I pulled 50 years of historical return data across gold, global real estate, and global equities to establish an objective baseline. This chart shows the nominal price histories of these three assets, but nominal prices offer zero insight into purchasing power. When we filter for real returns, the picture changes. High returns mean little if inflation runs equally fast. The ground rules are simple. We are using global equities, comprehensive property datasets covering developed markets, and gold price history starting in 1971. The data reveals no absolute winner. Instead, successful investing is a matching exercise between an asset's mechanical behavior and your current life constraints. Gold carries the reputation of the ultimate safe haven, a store of value that grows wealth while you sleep. The post-1971 data shows a different reality. Gold has delivered a real annual return of approximately 1 to 2% over the last 50 years. Look at the gap between the headline and the reality. $1,000 in gold in 1971 grows to over $90,000 nominally, but your actual real purchasing power is roughly $5,000. That long-term average also hides a 20-year bear market between 1980 and 2000. Depending on when you bought in, gold could have spent decades losing real value. Unlike stocks or property, gold produces nothing. There are no dividends to reinvest and no rent to collect. You are betting entirely on price appreciation, while foregoing the compounding power of income. Gold is a poor engine for growth, but it serves a specific function. It acts as crisis insurance during severe systemic shocks. Real estate is often viewed as a foolproof path to wealth, but that perception is skewed by a single factor most people overlook. For decades, housing has been the emotional cornerstone of the middle class. We remember the houses that 10x'd in value and forget the neighborhoods that stagnated. Historical data shows that true capital appreciation for residential property is barely 1% per year in real terms. Leverage is what makes that 1% return feel like a massive windfall. Buy a $400,000 property with an $80,000 deposit. A 10% rise yields a 50% return on your cash, but a 15% drop wipes out 75% of your deposit. Leverage amplifies everything. To match the returns of the stock market, a property must generate rental income. This transforms the investment into an active business, requiring management, maintenance, and the ability to handle vacancies. Real estate returns are significant, but they require active labor, high illiquidity, and the willingness to carry massive debt. Global equities are the boring winner of the data race. Broad global indexes have delivered 7 to 8% total real returns, provided dividends are reinvested. This curve shows the result of decades of passive compounding. You own a slice of thousands of companies growing and producing earnings for you. The catch is psychological. This return is the reward for surviving repeated market collapses. To get that 7%, investors had to hold through 50% drawdowns in 2008 and the sharp crash of 2020. The market recovered every time, but only the investors who did nothing captured that recovery. The data also shows that individual stock picking is a losing game. True long-term returns come from owning the broad market index, not trying to select the winners. Stocks offer the highest passive returns with zero leverage, but they extract their cost through the discipline required to not panic during a crash. Historical data only becomes useful when you apply it to your specific stage of life. This decision tree routes you to the optimal asset class based on your current constraints. If you are between 25 and 35, you have the time to absorb volatility. Global stocks are your clear winner for long-term growth. If you need your money in 3 to 7 years for a house deposit or a wedding, stocks are too volatile. Your priority is capital preservation, making high-yield cash the correct choice. If you already own a home, your balance sheet is already heavily weighted toward real estate. Stocks provide the diversification needed to offset that concentration. For those approaching retirement, the focus shifts to resilience. The active management burden and lack liquidity in physical property become significant liabilities. Shifting toward bonds and dividend stocks provides the stability and accessibility retirement demands. If you are worried about economic instability, gold has a place, but keep it to a fractional allocation of 5 to 10% to prevent it from dragging down your long-term growth. Following a strategy built for someone with a different timeline is a high-speed path to suboptimal returns. The family debate never ends because everyone is right for their own specific situation. Look at your own balance sheet and timeline. Identify your segment and drop your data-backed plan in the comments. Moving the conversation from anecdote to data is how you actually build a resilient portfolio. Stop arguing over the asset and start executing on the timeline.